To discuss this in greater detail, we now have Mr. Rahul Guha, Director at CRISIL Ratings Limited, now joining us. Mr. Guha, thank you so much for taking your time out and joining us here on ET Now. And the headline of your report says that profitability for poultry industry in the next fiscal after a strong FY24 and 25 is expected to decline by 50 basis points, and that is on account of rise in feed costs. Help us understand how much is feed cost expected to rise and what will the implications be? Sir, can you hear us? Please unmute your mic, sir.
Yeah. Thanks, Asesha, for having me here. As the report says that we expect a 50 basis points correction in the profitability, that's largely attributed to the feed prices which are going up. We need to understand that it's maize and soya which are the critical raw materials that are used for feed. And what we are seeing in terms of the maize prices, we expect about 5 to 7% kind of a jump that we will see this year. Likewise for soya, because of lower acreage, I think there also the prices for soya could see an upside of about 5 to 8% in the fiscal 26. So both these collectively put together will lead to about 50 basis points correction for the poultry players in terms of their profitability.
Okay, so that's as far as profitability is concerned. But what about revenue growth? What about volume growth? And in terms of revenue growth, help us break it into volume growth as well as realization growth. Do you expect realizations to pick up next year?
So let's first talk about the volumes. So I think volumes, if we break into the poultry into two parts, one is the broiler chicken and then the other part is the eggs. So I think on the broiler chicken, what we are forecasting is anywhere between 5 to 6% kind of a volumetric growth, backed by robust demand and easy source of protein. And I think the dietary requirements and the dietary preferences of the Indian community has been fast changing. On the egg side, what we are saying is about 4 to 5% kind of a growth in terms of, again, volumes. The prices on the broiler chicken will remain largely flattish, maybe 2 to 4 rupees kind of a jump per kilo is what we are anticipating. On the egg side, there could be an upside in the tune of about, again, 4 to 5% in terms of prices. So net on a weighted average basis, we expect that the industry could see about 8 to 10% kind of a growth YOY in terms of revenues.
YOY 8 to 10% revenue growth is what you're penciling in for FY26. But what after that? What about the next 2 to 3 years? Will the momentum sustain? What do initial trends indicate?
See, the realization prices are a function of both demand and also the raw material prices. Now, what has classically happened here is if you look at soya prices. Now, the soya prices, they were on a decline in the last couple of years. Obviously, the farmers, they will not sow soya and instead they will replace that with some other crop. What we understand from the market is almost 10 to 15% kind of an acreage loss has happened for soya. Now, what it will mean is automatically the soya prices will shoot up this particular year. As I explained earlier, about 5 to 7% kind of a jump is what we are seeing. So probably this is like a 2 year, 3 year kind of a phenomena. Maybe for the year 27 also, probably we will see at least a 4-5% kind of a price rise. And on the demand side, we do forecast that about 4 to 5% kind of a steady volumetric growth in both the pieces, that is the chicken as well as eggs. Collectively, again, 8 to 10% kind of a CAGR we are expecting for the medium term.
So that's as far as the revenue growth, volume growth, realization growth is concerned. But also wanted your thoughts on the credit profile of the total industry. I was reading your report and it says that incremental debt addition is expected to be on the lower side and the balance sheets of most of these companies are also strengthening. You tell us, how do you expect the credit profile to shape up for the industry as a whole?
So what has happened is there have been 2-3 good years in the past where they made good enough money, and on a capacity utilization side, most of these players are operating at around 65-70% kind of utilization rates, which means they do have enough headroom available for the 5%, 7% kind of volumetric growth, which we are forecasting over the medium term. That negates the need of any large capex. Secondly, we are not a processed poultry industry as such, as in the value added products that we do as an industry is barely about 8-10% of the overall revenues. So unless there is a significant push in terms of getting into the value-added segment, again, the need for capex doesn't arise. As a result of that, your overall capex debt will remain largely in control. Whatever will be the incremental debt will come in the form of only stock and receivables. So that's the incremental working capital debt that comes in. But as we already discussed, that we are expecting almost 8 to 10% kind of a revenue growth, and the working capital cycles have been largely controlled for these players, which means that the incremental working capital debt also will not be too significant. As a result, the overall debt remains controlled on the balance sheets. With an incremental revenue base that we are looking at, the balance sheets will strengthen in absence of any capex debt.
Balance sheets are expected to strengthen for the industry, but for all the companies that were under your review for the report that you've made, help us understand how much percentage of their revenue comes from export, and how is the export demand environment shaping up currently, especially with everything that's happening globally on the tariff war front, and especially when it comes to growth concerns. So how is the demand environment in the global market?
The demand environment remains flattish. There is no major upside that we are seeing in the major export destinations. Even for the players that we have rated in our portfolio, we don't see any major export upside. It's largely a domestic orientation that we look at when we talk about the poultry. And as I earlier said, we aren't a very value-added kind of a segment or value-added kind of a poultry industry. It's largely the raw chicken that we talk of, and in terms of eggs, also the raw eggs that we talk of. So we don't have an export orientation as such for the industry. It's going to be largely a domestic story for the industry.
Understood. Thank you so much for taking your time out and joining us here on ET Now and helping us decode what the outlook for the poultry industry looks like for the next fiscal. Shifting focus then from poultry